Why is your bank account getting poorer even when you're working harder and depositing more money into it? It feels like running on a treadmill that's slowly accelerating against you. Here is a fact that will shock you. As we move through 2026, the average traditional savings account in America is paying a pathetic 0.5% interest. But at the same time, real-world inflation is aggressively running at over 3.1%. Now do the math. This isn't just a slow crawl, it is a financial crisis in slow motion. You are losing 2.6% of your total purchasing power every single year. Your bank account isn't a high-security vault meant to protect your future. It is a leaking bucket, and the holes are getting bigger every day. The ice cube analogy. Think of your savings not as stacks of cash, but a giant block of ice sitting in the sun. Every day you leave it there, a layer melts away. You might still have the same number of dollars in your mobile app, but those dollars buy fewer groceries, less fuel, and less real estate than they did just 12 months ago.
The banking system has conditioned us to believe that safety means seeing a static number in a digital ledger. But in 2026, static is a death sentence for your wealth. The system is designed to reward the debtors and punish the savers by diluting the value of the currency you work so hard to earn. While you're sleeping, the purchasing power of your life's work is being quietly redistributed to the very institutions that are supposed to be guarding it. The Future Freedom 360 wake-up call. Nobody told you this because the banking system relies on your passive participation. They take your deposits, lend them out at 7 or 8%, pay you a measly 0.5%, and pocket the massive spread. They are getting rich off your leaking capital. Stay with me for the rest of this video because I'm going to show you exactly how to plug the holes. We are going to look at the Wise Money 360 strategy to convert your melting fiat into hard assets that the banks can't devalue. It's time to stop saving for poverty and start building for freedom. Let's break down the fix.
Let's be brutally honest for a second. You've been doing everything society told you to do. You work hard, you get your paycheck, you deposit it into your bank account. Maybe you even set up a little automatic savings transfer because you're disciplined like that. And yet, month after month, you feel like you're going backwards. Sound familiar? Here's the painful truth. You were handed a broken system and told it was a treasure chest. The bank account, the very foundation of responsible money management that your parents, your school, and honestly even most financial advisors pushed on you, is one of the single biggest reasons the middle class stays middle class. Now, I'm not here to sell you fear. I'm here to sell you facts. And today, we're going to break down exactly why your bank account is a leaking bucket in 2026, what's silently draining your wealth every single month, and most importantly, the 3 actionable moves you can start making right now to plug those leaks and redirect your money toward actual freedom.
Stay with me, because by the end of this video, the way you look at that little savings balance on your banking app will never be the same again. Let's start with the biggest leak in your bucket, and it has a name: inflation. Why does your money buy less every single year, even though the number in your account stays the same? That's not an accident. That's by design. Here's the 2026 data you need to hear. The U.S. Bureau of Labor Statistics confirmed that consumer price inflation is sitting at approximately 3.1% annually as of early 2026. Meanwhile, the national average for a standard savings account interest rate? Roughly 0.46%, according to the FDIC's latest published data. That's not even 0.5%. So let's do the math together. You have $10,000 in your savings account. Your bank rewards you with a grand total of $46 at the end of the year, but inflation just silently stole $310 worth of purchasing power from that same $10,000. You didn't lose money on paper, but in the real world, you lost $264 in actual buying power. That's the leak. That's the tax you never voted for.
Actionable tip number 1. Stop treating your savings account like a wealth building tool. It is a parking spot, a temporary holding area, nothing more. Your emergency fund, 3 to 6 months of expenses, absolutely belongs there. But anything beyond that emergency cushion needs to be deployed into assets that outpace inflation. We're talking about assets like index funds, cash flowing investments, or yes, Bitcoin, which we cover in depth in another playlist. The rule is simple. Idle cash is dying cash. All right, pattern interrupt. I want you to pull up your last 3 bank statements right now. Seriously, do it after this video, because what you're about to find is going to make your blood boil. Why do banks charge you a monthly maintenance fee just for the privilege of letting them use your money? Think about that for a second. You deposit your paycheck, the bank takes that money and lends it out to other people at 7%, 18%, sometimes 24% interest. They are literally profiting off your deposits. And then, and this is the part that gets me, they charge you a service fee for the inconvenience.
In 2026, the average American pays somewhere between $144 to $240 per year in bank account fees alone. That's before we even talk about overdraft fees, wire transfer fees, and out-of-network ATM charges. According to the Consumer Financial Protection Bureau, overdraft and non-sufficient fund fees alone generated over $7 billion in bank revenue in recent reporting years. $7 billion, taken directly from working-class account holders. Actionable tip number 2. Audit every single fee on your bank statements and eliminate them ruthlessly. Step 1. Switch to a high-yield savings account, HYSA. In 2026, some of the top HYSAs are offering between 4.5% to 5.1% APY. That's 10 times the national average. Institutions like credit unions and online-only banks often have 0 monthly maintenance fees and significantly better rates. The big traditional banks are not your friends. They are businesses optimized to extract maximum value from your inertia. Stop being loyal to institutions that are not loyal to you. Fraud alert, risk management section. And since we're talking about moving your money, I have to pause here and give you a critical warning.
Because whenever people hear, move your money to get better rates, scammers are right there waiting. In 2026, financial fraud targeting savers has exploded. The FBI's Internet Crime Complaint Center reported over $12.5 billion lost to financial fraud in 2025 alone, a record high. One of the fastest growing scams right now is the fake high-yield account scheme. You'll see an ad on social media, often impersonating a real bank or financial influencer, promising 15%, 20%, or even higher returns on a savings account. They collect your deposit, they vanish. Here is your protection checklist. Number 1, any legitimate HYSA is FDIC insured up to $250,000. Verify this independently on the official FDIC website at fdic.gov. Number 2, if a rate sounds too extraordinary compared to market averages, it is a trap. Number 3, never ever transfer money to an account based solely on a social media ad or unsolicited message. Always go directly to the institution's official website. Protect your capital first, always. Here's the final leak, and honestly, it might be the most important one, because this isn't about fees or inflation. This is about mindset.
Why do the wealthy get richer while the middle class works harder and stays stuck? It's not intelligence, it's not luck, it's velocity, money velocity. The wealthy understand one core law: money must move to multiply. A dollar sitting in a 0.5% savings account has near zero velocity. It's basically standing still. But a dollar invested in a cash-flowing asset, a dividend-paying index fund, a revenue-generating business, or an appreciating asset like Bitcoin, that dollar is moving, it's working, it's creating momentum. This is what I call the difference between dead assets and life assets. Dead assets are things like standard savings accounts and depreciating property that drain your cash flow. Life assets are things that generate returns, build equity, or appreciate faster than inflation. Actionable tip number 3, build what I call your money deployment system. Here's the framework. Every dollar that comes into your life gets assigned a job. Bucket 1, your emergency fund in an FDIC-insured HYSA earning 4.5% or better. Bucket 2, your investment capital, going into diversified assets, index funds, Bitcoin allocation if it aligns with your risk profile, or business reinvestment.
Bucket 3, your operation cash for monthly expenses.
kept lean and tracked weekly. No dollar sits idle without a purpose. That is wise money in action. Why are you still letting your money sit in a system designed to make the bank wealthy instead of you? The answer is simple, because nobody taught you the alternative, until now. If this video cracked something open for you, good. That's exactly what Future Freedom 360 is here for. Hit subscribe right now so you never miss a wise money law. And drop a comment below. Tell me, how much are you currently earning on your savings account? Let's see the real numbers. Your next move? Watch our video on dead assets versus life assets. The link is right here. Your future freedom starts with one decision. Make it today.